Welcome to part two of the June 21st, 2020 Wall Street Wednesday with Professor Milligan. In this section, I'm going to talk about technical analysis. I'm going to deal with support, resistance, and the descending triangle. All right, we're looking at a chart of Netflix. So I'm showing you a chart of Netflix. What you see right here is support line. You can see that every time the stock, and if I even drag this line all the way over here, you can see that when the stock has gotten up to this $400 range on Netflix, it hit resistance. It finally broke through that. And as you can see, that resistance that was here ends up becoming support over here. So you can see it. It's just to the top of the trading range here, and then it falls back down to support. Then it rallies back up to resistance. Then it comes back down to support. And then finally right here, you can see that it pushed through resistance to form a new trading range, and old resistance became support. Now it broke through this support short term here, but then it was up again today, the following day, and it's moved back up into this trading range. So that's what you're looking at. This is a trading range. So again, support, resistance. Resistance turns support. If the stock had broken down, this support would have then turned into resistance. And you'll see that on the next chart. This was Netflix, by the way. On this chart, you're looking at Microsoft. So what I did here was, let's go back. This was resistance. It finally broke through this resistance, had a small little trading range here, but then it came up here and formed a whole new trading range. Then we had the debacle of March, as you guys know, and you can see it broke down. It came to this support level and broke down again. Now, I can show you resistance lines here. I can show you some more here. I just only wanted to show you this. So now when the stock starts to work its way back up, you can see it fought through this resistance and then went back to this old trading range here, which is this line becomes support. Finally pushed through here again, pushed through this resistance, and that resistance came support, and there's another trading range. And it finally pushed through here again. And you can see it pushed back into it, but you can see it pushed right back in, and this is the trading range it's in now. So these are trading ranges. So to go a step further, if Microsoft doesn't hold this trading range and breaks this support, you can see where it's going to come down to its second support level. And if it's really in bad shape, it'll come down and even test this other support level. You can see what happened over here. It happened here. It broke down here, fell into this old range real briefly, broke down here, and you can see if I can put some lines on this. If I can, I'll try my best. And you can see right here's another line. And you can see right here, another trading range. And there. So you can see it on the way down, it hit all these trading ranges. It might have blasted through them, but you can see it blast through, tried to get back up, then it blasted through again, then it finally blasted through, then again, you can see there's support. Then it worked its way back up, traded through this resistance level, traded in the trading range, then broke through that resistance level, another trading range, another trading range. This is what stocks do, guys. Now you're looking at Google. Same story. Again, I focused on this side, but you can see these trading ranges. You can see it right here. You can see how this resistance line and then this support line, you can see how it goes all the way through over here. So here he is working our way back up, trading range, worked its way back up through a trading range, worked its way up through a trading range. Now here's what's interesting. Google is going to have some resistance up here at this above the 1500 level, probably 1600, somewhere around there. And the reason being, it's not going to have much, but you can see how there's stock hanging head over head here. So it broke through the old trading range, but couldn't hold it. So that's where we're at. Again, this is Google. These were done, I think, 2 weeks ago, and Google right now is actually back in this trading range, and actually, I believe it actually broke through it. Now you're looking at Facebook. Again, I just went to this. You can see it. Here it is right here. Trading range. Support, resistance. It broke support, but again, it traded right back up into this range. support resistance. You get an idea. Now you're looking at Chipotle, same thing, trading range. You can see how, here's another range right here. So rather than me highlight all of them, I'll just circle it. There's a trading range right here. There's another trading range right here. Sorry about that. Trading range right here. Yeah, that's right there. Boom. Take that one, extend over. Yep. And here's what's interesting. Boom. All right, so that's what we're looking at. So this is what people like me do. We look at this stuff, we go through it. Again, this is not going to make you money, but it might help you figure out when to get in, when to get out. Go a step further. If I'm extremely bullish Chipotle and I see it push through this resistance and on volume, I'm probably going to look to buy it. If I'm negative, if I'm bearish Chipotle and I see it trading in this trading range, I see it break support, then most likely I'm going to get short. All right, that's what we do. Now you're looking at what's known as a descending right triangle. Now, the reason why I call it a right triangle, you can see right here is the right angle. Now, in right angles, this is the descending. You also have ascending right angles. Typically, what's going to happen is the security is going to break to the right angle side. So this is a bearish signal, and I would look for this stock. So I'm going to add some lines to it. I look for this stock to break down here, and you can see that if it does break down, we're right here in another trading range. So if this stock breaks down, it's going to break down and come into this trading range right here. Now, I did notice that since I printed this chart, the stock has actually worked its way, well, that hasn't gone down, but worked its way through this. It's going up. But these are typically bearish chart patterns, which means that in most cases, you're looking for this thing to go down, not up. Again, you're looking at Boeing. This is Boeing. Here's another descending triangle. This happened before. You're looking at JCPenney. I put this up because I keep getting questions about JCPenney. So here's your descending right angle. And you can see this is typically what they do. It broke down and went lower from here. I drew this line here to show you the trading range. There's resistance, which is now for over here, support. There's the bottom of the trading range here. So again, on this, and I haven't looked at JCPenney's. It's not a stock that I follow, not a stock I have any interest in. If it wasn't for you guys asking me about JCPenney, I'd never look at it. So you can see that based on this, I would expect JCPenney to break down again into this trading range and trade between 20 cents and 0. Now, I've had questions about, I guess, Kanye West is putting his label up with them and he's in some agreement. So I guess you guys are expecting that to drive the stock up. My point to you, I would say, is that I'm not sure if he can drive the stock up enough to get it out of these problems that they're having. You're putting a lot more faith in Kanye West than I am. But again, this is what you're looking at. This is a descending right triangle. And you can see on the first one, it actually did descend. The second one was still waiting to see. I haven't looked at it. We're now looking at the S&P 500. And again, real quick, there's a whole bunch of little support trading ranges in here. I just wanted to show you this ascending triangle. And there it is. And you can see now it's worked its way back up through here, but this is ascending triangle, which typically is bearish. So it's worked its way back up. I believe the S&P right now is trading close to or near its all-time high. You're looking at the spider right now. You're looking at the ETF on that. But again, you can see the descending triangle. Now you're looking at Delta Airlines. Delta Airlines, again, there's your descending right triangle. So this is a bearish triangle. You can see here, right here at 200, it's gonna be $20, somewhere around in this range is support level, near-term support. So if delta does break down and break below this descending right triangle, expected to trade between this $26 and $20 trading range. If it does work its way back up, you can see that right here is your new resistance. So again, putting this into a trading range. If it breaks support, this is your new trading range. If it breaks through this, it'll actually get into a new, back into and stay in this trading range right here. You're looking at Disney now. I did the same thing. Now I started showing you different levels of, so this is the trading range. There's your descending right triangle. There's your trading range. If it does break out of this out of this descending triangle to the upside, it's going to trade between 120 and 109. If it does break down, it's going to trade between 109 and 100. This is what we expect. And you can see up here, there's stock hanging overhead. This stock is hanging overhead. That's what we call this. It might not be overhead here, but there's a whole bunch of investors in the stock in this range who brought the stock, who are just waiting for nothing but to get back to this 150 level. So it's going to take some work to get through there, because you have these sellers that are going to naturally just drop stock on on top of this, because they don't want to be in it anymore. They wrote it down and they'll sell it into the rally. It's typically what they do. Again, another ascending triangle, descending, excuse me. This is Gap store, so I want to put Gap up. You can see what happened here. So there's the trading range it was in. You can see it broke through this trading range and formed a whole new trading range. And forming that trading range also, it put together descending triangle. And you can see right here, it broke out of that triangle, but it stayed in this old range right here between 14 and 10. So I would expect the stock to trade between 14 and 10. You might see that narrow down. It's a big swing. And if it finally does push through the 14 level, you've got some resistance here at about 15, but your major resistance is going to show up around 17 right here. Right here. This stock is still hanging out waiting for you guys. So there's the old trading range based on what happened right here. This stock, so if it makes its way back up through here, it's going to, and works its way up, there's stock hanging overhead here. There's old trading range. All right, so those are a couple of charts for you guys to digest. We also talked about economic indicators. I talked about the yield curve. Here is a yield curve. There are 3 different yield curves that you're looking at right now. This one down here is current. The light gray one was 2019, and the darker gray one was June 2018. So let me explain what's going on here now. In 2018, we became inverted. Inverted means that the short term, right here, short term rates, it looks like about 2.25, 225 basis points, where the 1 year, 3 year, 5 year, and even 10 year were all underneath that. This is the Fed trying to slow down the economy's growth. We're growing too fast. They're fighting inflation. 2019, we went to classic. Every inverted yield curve, and I'm going to circle this because it's that important. And I have it on another slide, but I'm going to circle it now so you guys can see it. Every inverted yield curve we had in my lifetime, inverted right here, has led to a recession. And the time frame is anywhere from 6 to 18 months. It takes, we are one of the largest economies in the world. This is the Titanic. So moving it from one place to another, moving it from an inflationary economy to one that's slowing down growth takes a lot of work, and a lot of effort and time. This is the reason why I call the inverted yield curve a leading indicator. This is what the yield curve looks like now. The yield curve now, short-term rates are down at 0. And you can see our 30-year treasury is below 1.5%, 150 basis points. I believe right now it's at 1.68. I have to double check, but we're right around here. All right, this is a classic yield curve. So let me break down how this works. In a classic yield curve, which is extremely bullish for the economy, you expect the economy to grow and do well. And it will. Money's cheap for corporate America. But what happens is, as money stays cheap for corporate America and we start to do really well, we start to worry about inflation. If we worry about inflation, the number one way that the Fed will fight inflation is by raising short-term rates, federal funds rate to be exact. So the Fed will start to raise short-term rates. And you can see that that's what happened here in 2018. If the Fed raises short-term rates and we become inverted, this is going to slow down. The reason why and I'll show you some other ones that even more than this, but we became inverted. Not long-term, but intermediate investors are now saying, I should need to come out of this end of the market. Now you're looking at three different distinctly inverted yield curves that have led to recessions. First one, the top one is the orange one. This is in 2000, the dot-com bubble. We became inverted. You can see that short-term rates were higher than the 10-year and higher than the 20-year, actually higher than the 30. We were inverted. And again, that the dot-com bubble was what, was the catalyst that set it off, but that's what happened. Green one, 2007, we became inverted right here. We became inverted. You can see that short-term rates are higher than the 10-year, the 20-year, and the 30-year. We were inverted. Again, it led to another recession. The catalyst that set it off was the real estate market, but the yield curve was telling us before that happened that we were going to have problems. And here we are in 2019, again, inverted. Not nearly as inverted as the first two, but we're inverted. And you can see that short-term rates are higher than the intermediate stuff. So this is inverted yield curve. Every inverted yield curve we've had, especially when the short-term rates are higher than the 10-year, has led to a recession in my lifetime. Next, I'm looking at the 200-day moving average. The 200-day moving average is this blue line right here. It's a rolling average. So what they do is they take, from this point today, they'll count back 200 days. They'll add up all the prices over 200 days, divide it by 200, and that's where the line will be. The reason why I'm showing you the 200-day moving average is because Wall Street considers the 200-day moving average as a bullish or bearish sign. If the market's trading below the 200-day moving average, we are said to be in a bearish market. If it's trading above the 200-day moving average, we're in a bullish market. So you can see right here, Wall Street would call this a bullish run right here. Now we had a short term here and another short term here, but we're above the 200-day moving average, so Wall Street considers this bullish. I went back to 2007, 2008. You can see what happened right here. So again, yield curve was inverted, which I just showed you. The market broke below the 200-day moving average. And for the whole year of 2008, it broke below the 200-day moving average, and it stayed below the 200-day moving average. Right here in the recovery in 2009 is when it started to work its way back through it. We got choppy here, but again, you can see what's happened, and we've basically been in a bull run since 2009. Now I'm looking at unemployment. This came from the Federal Reserve, one of the Federal Reserve banks. This one came from St. Louis Federal Reserve. And these gray areas are recessions. This blue line is unemployment. So you can see the two pretty much go hand in hand. Unemployment might not lead a recession, but once we get into recession, unemployment spikes. You can see it. So you can see it here, you see it here, and here's the last spike. This is us right now in 2020. Now, we haven't had an official declaration of that we're in a recession or we're in a recession. And the definition of recession is two quarters of negative growth in GDP. So we've already had one quarter. The second quarter just ended. So July, I believe it's July 30th, second quarter GDP is due out. So we'll get to see what those numbers look like. If it's another negative quarter, it's just, now they can officially say that we were in a recession. 2 quarters of negative GDP is a recession. So you can see it. I mean, you can argue with it. You can explain it away if you want to. But again, you can kind of see what happens. The question you got to ask yourself, which happens first? Does unemployment lead to recession, or is a recession leading to unemployment? Well, in this case, in my opinion, which I've seen, I don't understand how you could expect the economy to grow when unemployment's at this level. So that's the reason why another reason why I think that this is going to actually lead us right into recession, 2/4 of it. On this chart, you're looking at the same thing. Now, what you're looking at is the yield curve. This side is showing you the spread between the 10-year Treasury and the 3-month Treasury. So when the 3-month Treasury, 3-month, is greater than the 10-year, you get a negative number here. All right. So that's an inverted yield curve. And the reason why it's inverted, because you're down here in the negatives, which means that the 3-month is a larger number than the 10-year. So here you have, it says your first one, 82, and there's your recession. We became inverted again in 88, there's your recession. We became inverted again in 2000, 2001, and there's your recession. We became inverted again in 2007, and there's your recession in 2008. We became inverted in 2018. We still have to see what's going to happen in 2020. But again, all I'm showing you that is these inverted yield curves typically lead to recession. It's not a coincidence. I want to thank you guys for coming to my Wall Street Wednesday. This is part 2. This is the actual diagrams and illustrations of what I cannot show you during my Instagram Live. But again, as you guys know, I post all this on YouTube under my channel, which is Professor Milligan. So please follow me there and use this information. Look at these charts. Look at this video. Watch it. Pause it and watch and look and learn. That's what it's here for.